Hello everyone, and this lecture is going to cover current liabilities. Some of the items that we're going to cover in this lecture include distinguishing between current and long-term liabilities. We're going to account how we account for notes payable and interest expense. We'll talk about how we account for employee and employer payroll liabilities. We'll explain the accounting for other current types of liabilities and also for contingencies. And then last we'll look at the liquidity using current liability ratios. So in the previous lectures we've talked about, we've worked our way down the asset side of the balance sheet. We've looked at cash, accounts receivable, inventory, and then long-term assets. Now we're going to turn to the other half of the balance sheet and start at the top of the liabilities, which is current liabilities. So this first section is going to distinguish the difference between what is a current liability versus what is a long-term liability. So in a classified balance sheet, we categorize liabilities as either current or long-term. In most cases, current liabilities are payable within 1 year, and long-term liabilities are payable more than 1 year from now. Current liabilities are usually, but not always, due within 1 year. But for some companies like a winery, it might take longer than a year to perform the activities that produce the revenue. So we call the time it takes to produce revenues the operating cycle. If a company has an operating cycle longer than 1 year, its current liabilities are defined by the operating cycle rather than by the length of a year. Now, the U.S. airline industry has experienced a lot of financial difficulties over the past several years, resulting in greater risk to investors. Several major airlines were forced into bankruptcy because they weren't able to pay current liabilities. So as this slide shows, an excerpt from the annual report of United Airlines, how they talk about this problem. It says here, they've faced severe business challenges and fundamental industry changes which have produced adverse impacts on earnings and financial position along with liquidity. The growth of low-cost carriers has increased, excess seat capacity, pricing transparency, reduced demand for high-yield business travel, global events such as the war in Iraq, the diseases, terrorist attacks, all of those plus taxes have just really caused the earnings to decline. What obligations do firms most frequently report as current liabilities? Well, notes payable, accounts payable, and payroll liabilities are the three main categories. In addition, companies report a variety of other current liabilities, including deferred revenue, sales tax payable, and the current portion of long-term debt. There's no prescribed order for presenting accounts within the current liabilities section of the balance sheet. This slide shows the current liabilities section of Southwest Airlines. Like Southwest, many companies first list notes payable, which Southwest calls current debt, followed by accounts payable, and then other current liabilities. Let's look at a question. Which of the following is typically considered a current liability? Would it be salaries payable? Would it be prepaid insurance, mortgage payable due in 30 years, or accounts receivable? Now, think of this a minute. Prepaid insurance and accounts receivable are what? They are not liabilities. They're assets, current assets. Mortgage payable due in 30 years, would that be a current liability? No. Salaries payable are due within 1 year. The mortgage payable due in 30 years would be a long-term liability. So now we're going to look at accounting for notes payable and the applicable interest expense. So in a previous chapter, we saw how companies account for notes receivable. Here we discuss the flip side, notes payable. When a company borrows cash from a bank, the bank requires the firm to sign a note promising to repay the amount borrowed plus interest. Now remember, banks just don't borrow money for free. Interest is the revenue they derive from lending money. The borrower reports its liability as a notes payable. Companies often use short-term debt because it usually offers lower interest rates than long-term debt. When a company borrows money, it pays the lender interest in return for using the lender's money during the term of the loan. Interest is stated in terms of an annual percentage rate to be applied to the face value of the loan. About 2/3 of bank loans are short-term. Now, this slide shows how to calculate interest. Interest is stated in terms of an annual percentage rate to be applied to the face value of the loan. Because the stated interest rate is an annual rate, when calculating interest for a current note payable, we must adjust for the fraction of the year the loan spans. So let's assume Southwest Airlines borrows $100,000 from the Bank of America on September 1st, 2018, signing a 6% 6-month note for the amount borrowed, plus accrued interest due 6 months later on March 1st, 2019. On September 1st, 2018, Southwest will receive $100,000 in cash and record this entry: a debit to cash of $100,000, a credit to notes payable of $100,000. However, if Southwest's reporting period ends on December 31st, 2018, the company wouldn't wait until March 1st, 2019 to record interest. Instead, the company records the 4 months interest incurred during 2018 in an adjustment prior to preparing the 2018 financial statements. Since the firm will not pay the 2018 interest until the note becomes due, which is March 1st of 2019, it records the $2,000 interest as interest payable. When the note comes due on March 1st, 2019, Southwest will pay the face value of the loan, the $100,000, plus the entire $3,000 interest accrued or incurred, which would be the $100,000 times 6% times 6/12 would be the full amount. The $3,000 represents 6 months of interest, but 4 months of interest, the $2,000, happened in 2018, previously recorded as interest payable. And the 2 months of interest, the $1,000, occurred in 2019. Now, Southwest records these transactions on March 1st of 2019. So the entry on March 1st does the following. It removes the note payable of $100,000. It records interest expense for January and February of 2019 for $1,000. It removes the interest payable recorded in the December 31st, 2018 entry of $2,000. And finally, it reduces cash of $103,000. Now, a key point to remember is we record interest expense in the period in which we incur it. It's not recorded in the period that it's paid, but when it's incurred. Here's another question for you. If a company signs a $10,000 5% 6-month note payable on October 1st, how much interest would be recorded by December 31st of the same year? Remember, this is 3 months of interest. That 5% interest rate is on an annual term. So the interest would be 10,000 times 5% times 3/12. That's going to give us $125. Let's look at an exercise to help understand this information. So this exercise is 8.2b. I guess I should say problem 8.2b. Eskimo Joe's designer of the world's second best-selling t-shirt, just behind Hard Rock Cafe, borrows $21 million cash on November 1st, 2018. Eskimo Joe's signs a 6-month, 7% promissory note to Stillwater National Bank under a prearranged short-term line of credit. Interest on the note is payable at maturity. Each firm has a December 31st year end. So we're required to prepare the journal entries on November 1st, to record the note payable for Eskimo Joe's, and also the note receivable for the bank. We're going to record the adjustment on December 31st for Eskimo Joe's and Stillwater Bank, and then we'll prepare the journal entries on April 30th of 2019 to record the payment of the notes payable and for Eskimo Joe, and then for the note receivable for Stillwater Bank. So we're doing both sides of the transactions. So first we're going to prepare the journal entries on November 1st. So for Eskimo Joe's, they are receiving $21 million cash, a debit, and a credit to notes payable of $21 million. Now, if you think about the bank, we will debit notes receivable for $21 million and credit cash of $21 million. Next, to record the adjustment on December 31st, for Eskimo Joe's, we need to show the interest that is due. So we will show $21 million at a 7% interest rate times 2 months out of 12 months. $245,000 will be a debit to interest expense with a credit to interest payable. The bank is going to have a debit to interest receivable and a credit to interest revenue on December 31st. Then, when this note is paid, we will show for Eskimo Joe's a debit to notes payable because we're zeroing out the note. We're going to show the interest expense for 2019, which is 4 months because this is paid on April 30th. So we have to show the $21 million at 7% times 4 months out of 12 months, which gives us the $490,000. The interest payable that we recorded in the previous journal entry that we credited, we're now debiting it because we're paying it off with a credit to cash of $21,735,000. Now, the bank is receiving the $21,735,000. It already recorded the revenue that was earned in 2018, but it had an interest receivable out there that we will now credit to zero it out since we're getting the cash. We'll show the interest revenue that has accrued from January through April 30th on this note, and then we will credit the note's receivable of $21 million since it is being paid off. It's really, really important to recognize which side are we dealing with, the borrower or the lender. And if it's the borrower, it's an interest expense and it's a note payable. If it's the lender, it's going to be a receivable and it's going to be revenue. Many companies prearrange the terms of a note payable by establishing lines of credit with banks. A line of credit is an informal agreement that permits a company to borrow up to a prearranged limit without having to follow formal loan procedures and prepare paperwork every time. Notes payable is recorded each time the company borrows money under the line of credit. However, no entry is made up front when the line of credit is first negotiated, since no money has yet been borrowed. Now, if a company borrows from another company rather than from a bank, that note's referred to as commercial paper. The recording for commercial paper is exactly the same as the recording for a notes payable that we talked about earlier. Commercial paper is sold with maturities normally ranging from 30 to 270 days. Since a company is borrowing directly from another company, the interest rate on commercial paper is usually lower than on a bank loan. Because of this, commercial paper has become an increasingly popular way for large companies to raise funds. Here's a key point to recognize. Many short-term loans are arranged under an existing line of credit with a bank, or for larger corporations in the form of commercial paper. Commercial paper is lending money from one company to another. Accounts payable, which we sometimes hear it's called trade accounts payable, are amounts the company owes to suppliers of merchandise or services that it has bought on credit. When a company purchases inventory on account, which means when it doesn't pay the bill immediately with cash, it increases inventory and accounts payable. Later, when the company pays the amount owed, it decreases both cash and accounts payable. Most accounts are payable within 1 year and are therefore classified as current liabilities. Next, we're going to talk about accounting for employee and employer payroll liabilities. This illustration summarizes payroll costs for employees and employers. As you see here, employees will have federal and state taxes, employee portion of Social Security and Medicare, employee contributions for health, dental, disability, life insurance, and employee investments in retirement or savings plans, where employer cost would be the federal and state unemployment taxes, the portion that the employer has to match for Social Security and Medicare, the employer contributions for the various types of insurances, and the employer contributions for various retirement or savings plans. Now, companies are required by law to withhold federal and state income taxes from employees' paychecks and to remit those taxes to the government. The amount withheld varies according to the amount the employee earns and the number of exemptions the employee claims. Employers also withhold Social Security and Medicare taxes from employees' paychecks. Collectively, Social Security and Medicare taxes are referred to as FICA taxes, named for the Federal Insurance Contributions Act. FICA, Federal Insurance Contributions Act. This act requires employers to withhold a 6.2% Social Security tax up to a maximum base amount plus a 1.45% Medicare tax with no maximum. Therefore, the total FICA tax is 7.65%, which is the 6.2% plus the 1.45%, on income up to a base amount of $118,500 as of 2015, and it keeps going up every year, and 1.45% on all income above the base amount. By law, the employer pays an additional matching FICA tax on behalf of the employee. The employer's limits on FICA tax are the same as the employee's, so the government actually collects 15.3% on each employee's salary, which is the 7.65% by the employee and the 7.65% by the employer. Now, in addition to FICA, the employer must also pay federal and state unemployment taxes on behalf of its employees. The FUTA, or the Federal Unemployment Tax Act, requires a tax of 6.2% on the first $7,000 earned by each employee. This amount is reduced by a 5.4% maximum credit for contributions to state unemployment programs. So the net federal tax is usually of 0.8%. Under the State Unemployment Tax Act, which is SUTA, in many states the maximum state unemployment tax rate is 5.4%, but many companies pay a much lower rate based on past employment history. Additional employee benefits paid for by the employer are referred to as fringe benefits. Employers often pay all or part of employees' insurance premiums and make contributions to retirement or savings plans. Now, to help understand how employee and employer payroll costs are recorded, let's assume that Hawaiian Travel Agency has a total payroll for the month of January of $100,000 for its 20 employees. Its withholdings and payroll taxes are shown in this slide. The journal entry that's shown here records the employee's salary expense, withholdings, and salaries payable on January 31st. So you see here the salaries expense is $100,000. The income tax payable it gave us is a credit to $24,000. The FICA tax payable $76.50, and the salaries payable would be the net $68,350,000. Now, Hawaiian Travel Agency also records its employer-provided fringe benefits as salaries expense and records the related credit balances to accounts payable as shown in this journal entry. The company also pays the employer's FICA taxes at the same rate that the employees pay the 7.65% and also pays the unemployment taxes at the rate of 6.2%. The employer's payroll taxes are recorded as shown in this entry. So as you see, the company incurred an additional $28,000 in expenses, the $15,000 for fringe benefits shown here, plus the $13,850 for employer payroll taxes beyond just the $100,000 salary expense. Also note that the FICA tax payable in the employee withholding is the same amount recorded for the employer payroll tax. That's because the employee pays 7.65% and the employer matches that amount with an additional 7.65%. The amounts withheld are then transferred at regular intervals, monthly, quarterly, or sometimes even weekly, to their designated recipients. Income taxes, FICA taxes, and unemployment taxes are transferred to various government agencies and fringe benefits are paid to the company's contractual suppliers. Now, a common mistake many people make is they think FICA taxes are paid only by the employee. That's not true. The employer is required to match the amount withheld for each employee, which effectively doubles the amount paid into Social Security. Another point to make, employee salaries are reduced by withholdings for federal and state income taxes, the FICA taxes, and the employee portion of insurances and potential retirement contributions. The employer also incurs additional payroll expenses for unemployment taxes and the employer portion of FICA, insurance, and retirement contributions. So let's look at a question here. Which of the following items is paid solely by the employer? Is it federal and state income taxes on employees' wages, Social Security taxes, federal and state unemployment taxes, or would it be Medicare taxes? Well, federal and state unemployment taxes are not paid by employees. They are only paid by employers. Companies are required by law to withhold federal and state income taxes from employees' paychecks. Employers are also required to withhold Social Security and Medicare taxes from employees' paychecks. And in addition, the employers may withhold optional deductions such as insurances, contributions to retirement plans, and other fringe benefits. Unemployment taxes are not withheld because they are paid solely by the employer. Let's look at a problem here. The following selected transactions relate to liabilities of Rocky Mountain Adventures. Rocky Mountain's fiscal year ends on December 31st. So we have 3 transactions. On January 13th, we negotiate a revolving credit agreement with First Bank that can be renewed annually upon bank approval. The amount available under the line of credit is $10 million at the bank's prime rate. February 1st, arrange a 3-month bank loan of $5 million with First Bank under the line of credit agreement. Interest at the prime rate of 7% is payable at maturity. And then May 1st, we pay the 7% note at maturity. So our job is to record the various entries on each of these dates. So as you see, the January 13th significance of negotiating a line of credit, it was discussed, but there was not a financial transaction that occurred at that time. Now, February 1st, arranging a 3-month, $5 million note with First Bank with the line of credit. At that time, we did arrange it and create the agreement. So February 1st shows a debit of cash for $5 million, a credit of notes payable for $5 million. And then on May 1st, when we paid the note with interest, we will debit that notes payable to wipe it clean. We will show the interest expense we were responsible for, the $5 million at 7% for 3 months, and the $5,087,500 would then be recorded as a credit to cash.